And the fact that we are there and people don't perceive that as risk is just tells me that investors are completely clueless about the actual risk of things. And I think the equity markets is still living in that environment, and it's still living in an environment that people used to think where zero interest rates allow multiples to be at extreme levels. And I looked at the Dow Jones and other indices relative in gold prices. And today the Dow Jones or the S&P and other are actually at the same levels they were at the very peak of the 1929.
Tavi Costa returns to the show. He is a portfolio manager of Crescat Capital. And today he's going to be making the case for why recession indicators are stronger than ever. I know we've been talking about a recession for quite some time. It hasn't technically happened, but Tavi says now is the time to pay attention. These indicators are very strong. The economy is deteriorating fast. Citibank, which we'll talk about today, has an analyst report that broadly supports his thesis. So what's next for the markets? Tavi will walk us through his investment thesis with us for the remainder of 2024, where to look, where to place our money. Now, if you don't have time to watch all my interviews on a weekly basis, I post once to twice a week, a day rather, once to twice a day. So 10 to 12 times a week. You can sign up to my upcoming newsletter, which I'm launching in July this month. And it basically summarizes and recaps the week's highlight videos, top news to watch for the remainder of the week and next week. And I'll be adding a little bit of my own thoughts and analysis as well. Put your email in the link down below. Sign up. It's completely free, and you'll be one of the first to receive the first issue coming out this month. Weekly newsletter. You don't want to miss it. It just complements the listening and viewing experience in a print format. So stay tuned for that. Tavi, welcome back to the show. Good to see you as always.
Thanks for having me, David. Looking forward to this.
Looking forward to it as well. Always good to have you back. I like to start off by reading one of your tweets from today, the 9th of July. You said that I wouldn't be surprised if the 2-year yield retests its breakout level, forming major support around 2%. The risk of a recession has significantly increased in recent months, particularly with the steepening of the yield curve from a deeply inverted levels, crack in the labor markets, and growing signs of decelerating growth, while earnings expectations remain unrealistically high. Interestingly, today's suppression of volatility is characteristic of what we often see before a recession, commonly referred to as the calm before the storm. Large interest rate cuts have yet to become a central narrative, and in my view, now is the time to T-bill and chill. Lots to go over there. Let's break this down one at a time because that basically sums up the entire macro conversation. T-bill and chill. What do you mean by that? Let's start there.
Well, although I'm showing a chart of the 2-year yield, I do think that the short-term rates or short-term instruments in the treasury market look much more attractive than not only the equity markets, but a lot of other instruments out there. But that's really predicated on the view of what I think it's one of the most important developments in the macro setup happening currently, which is the steepening of the yield curve. The steepening of the yield curve, after being deeply inverted, as we all know, is often a sign of a recession. And a lot of people tend to see the steepening itself as perhaps as a healthy part of the economy for the fact that we're seeing positive things coming along, and therefore the steepening is caused by that. However, when it's actually coming from a deeply inverted level, that is usually a sign of a very strong sign of a recession. In fact, I don't think has ever been a false positive in terms of that recession signal. So I think that the 2-year yield, interest rate cuts, and all sorts of things are actually a part of the narrative that is yet to come. The Fed is basically facing, in my view, a stagflationary environment. And one of the charts I posted recently had economic surprise index falling apart. I think it's at a decade low. And if you look at inflation expectations, it continues to rise in different ways. Although the CPI number by the Fed is not increasing yet to the same degree that other measurements that we actually calculate and others that tend to have a very strong historical correlation with measuring inflation over time. And so, in my opinion, the Fed is basically facing a very difficult situation where inflation is still deeply embedded in the economy. But we're starting to see cracks in not only labor markets, which is their dual mandate is inflation in labor markets, but also the economy itself. And so at what point does the Fed start staking the card of the cracks in labor markets to justify interest rate cuts I think we're getting close to that point, and I think we're getting a lot closer to that point than most people believe. And the main situation is given where we are in terms of the setting. I mean, a year, or I should say 6 months ago, the fact that we had 7 interest rate cuts already priced into the futures markets makes me believe that there was a very crowded opinion that we would see multiple interest rate cuts. Now, the change from that to now seeing less than 2 cuts priced into the curve makes me believe that people have already priced in the idea of inflation reaccelerating, therefore that shift, but they're not really understanding the fact that there is a recession signal ahead that could potentially cause the Fed to panic and start really cutting rates. So I'm sorry for the long answer here, but I really think that it wouldn't surprise me, and I actually think it's very, very plausible way to be not only long the steepener, but really because the 2-year yield is much more likely to fall in the near future. And on top of it, you have elections. And I think that we're seeing this flood of issuances, especially coming on the long end of the curve, while central banks have not been buying treasuries to the same degree they used to, creating a lack of demand relative to supply. And so that can also cause the long end of the curve to rise significantly. And so the steepening of the yield curve is, to me, one of the best macro trades that I've seen here for the next 6 to 9 months, in which I think it's playing out and will play out even more in the near future.
Before we continue with the video, I want to tell you about one of the best performing assets this year, gold. The price of gold keeps rising. It's no mystery why. The Chinese central bank is stockpiling gold in the face of deglobalization, while Chinese citizens are buying gold hand over fist to protect their wealth amidst a real estate crisis, a stock market going nowhere, and low interest rates, all seismic shifts for a country that enjoyed immense growth for 20 years. These forces are here to stay, and they're strong. They've created such momentum that gold is now attracting interest from Western investors. The chart is bullish, the arguments are many, and the move is still young. When gold rises, companies putting new gold mines into production usually rise the most. It's called leverage. West Red Lake Gold Mines, today's sponsor, is one of the few Canadian gold stocks putting a gold mine into production in this exciting gold market. The Matson Gold Mine is largely built, and West Red Lake Gold knows exactly what it needs to do and when to achieve its goal of getting this high-grade gold mine back in operation in 2025. West Red Lake Gold is a stock made for this gold market. Learn more in the link down below or scan this QR code here. When you say that the 2-year is going to come down, you're not just talking about a slight move, though. You're talking about currently we're at 4.6% to down to 2%. That would make the 2-year the lowest it's been since 2022, right? Why such a dramatic move, though?
Because that's what the Fed does when they panic. And I do think that that's essentially what's going to happen. Not only that, we have a problem. 3 interest rate cuts, just to give you a sense, would reduce the interest payment today by about almost 1/3. That's a significant change in something that is now 4% of GDP. Net interest payments are close to 4% of GDP now. And so I think that's going to become the Fed's mandate. Forget about inflation, forget about labor markets. I think interest rate payments and the fact that the government needs to finance its debt at a decreasing demand, gradual decrease in demand for its own government instruments, which are treasuries, I think that it ultimately creates the Fed's role into shifting towards actually being the ultimate financier of that debt problem. And so, we're in the process of seeing this. I mean, we talk about fiscal dominance, right? A lot of people talk about that term of fiscal dominance, but really it's a real dominance coming from the US relative to other places. In fact, that is what justifies this growth that we see in the US versus other places, is the fact that we have such a large amount of fiscal stimulus. And what allows the US, now we really need to think this through, like what allows the US to have that dominance relative to Europe and other places. And the main reason is the reserve currency status, is the fact that they need dollars, and therefore we continue to run a deficit in not only the fiscal side, but the current account side, that allows those folks to, or those countries, those economies to absorb dollars. Now, one thing is to run a twin deficit. The other thing is to run a double-digit twin deficit, which is what the U.S. has been doing for a long time now. I think that's a very structural problem to the dollar over time, and it forces the Fed to actually have to cut interest rates at some point. The fact that we're not seeing, technically speaking, I believe we're seeing the signs of a lot of currencies starting to show, less and less weakness relative to the dollar. I think we're in the process of a bottoming, and the bottoms usually, technically speaking, they take time to sort of develop. And I think we're in the process of seeing the dollar bottoming now, or I should say, other currencies bottoming relative to the dollar. The euro, the Canadian dollar, the Japanese yen has been, I think, the most contrarian view here probably would be that it's likely to actually reverse, and others. And the main reason for this is because if the Fed is unable to keep this level of fiscal dominance moving forward, it would change a lot of things. We got to think about the ramifications of that. The ramifications are in FX, as I said. The ramifications is in growth. Can we keep this growth relative to other places? Probably not. Then it questions earnings for corporations in the US, because growth will ultimately hurt earnings of corporations. And so we got to think about this recent divergence of US equity markets versus other places in the world. So this is a big theme, kind of a theme in the macro side, that I think it's kind of in the process of well, actually not in the process just yet, but it's to me, it's going to be the next narrative as we see this fiscal dominance of the US relative to other places shifting away, and the cost of keeping that fiscal aggressiveness starting to outweigh the benefit of it, and ultimately causing the Fed to have to reestablish financial repression to lower the cost of the debt and the servicing of that debt relative to GDP. It's a big theme, but I think it's very, very relevant.
Okay, just to clarify, you're not calling for a bear steepener. You're calling for a bull steepener, right? Basically, you're saying the short-term rate is going to fall more than the long-term. You're not saying that the long-term yield, the 10-year, is going to go up and the 2-year stays flat, right? Because
It's a good question. It's a
yeah,
very good question, because a lot of people want to know what do you think about the state. What we've seen so far recently, it's actually very remarkably similar to the mid 70s, early 70s in terms of, during that period, the 10-year yield was actually rising. So we saw a bear steepener in that case, while we had actually the short end of the curve not really moving higher. I'm referring to a stagflationary type of crisis. Bear steepener is very normal. It's very inflationary. I think that it doesn't jive with what I just said about the 2-year yield. I don't think you really need to answer the question that you just asked. I think a steepener will happen, just because that's what tends to occur after a deeply inverted yield curve, particularly at a time when we've had as inverted of a period as we've seen in history. And so to me, this is, just reemphasizes the need for the yield curve to actually steepen. And I can see, a world where, let's just say, just as an example here, I don't know who is likely to, well, I know who is likely to win elections. I don't know who is going to win elections, but let's assume who is likely to win, Trump actually wins. And I'm using the betting odds. That's not my opinions, just looking at the betting odds of likelihood of him winning.
right.
Assuming that happens, I can see, a world where he's trying to cut taxes and actually spend even more.
Yes.
I can see a world where the 10-year yield may not like that, and the long end actually goes a lot higher. So I don't want to be cute in saying I think it's going to be a bull steepener versus a bear. I don't know. Honestly, it doesn't attract me to buy the 10-year yield, to be honest. And so
the only reason I ask that is because historically a bull steepener, meaning the 2-year coming down, has meant good news for equity markets. It usually signals because the Fed is cutting rates, the economy may be stimulated. So that's bullish news, hence the term bull steepener. I don't know, we don't have to put labels on it, but I'm just wondering if that's your narrative for the equity markets and the economy?
I don't have much of an opinion on how it's going to, the steepener will actually develop. If you put a gun in my head, I actually think the bear steepener is more likely, which is
Okay.
not necessarily necessarily a view of the
Well,
2 year yield
let's just
dropping
talk
further.
about how you think the equity markets will react to this surprise, I guess, cut from the Fed.
Well, I don't think it's positive. I think the equity markets, the reason behind the cut is not to necessarily with the idea you can cut this in both ways. There's people who will say if you cut interest rates, it sort of reemerges the idea of reaccelerating growth, and the other way around is the Fed is panicking, the economy is not doing very well, and therefore why cuts are actually very negative for the economy and therefore should be seen a compression of multiples. I am more of that view. And the main reason for that is because even rates at 2%, 2.5%, or even 3%, let's just say the 2 yields does get to a 2% level or so, it still is higher than we've seen historically. I mean, we've been living in a world of NIRP or ZIRP, of near zero interest rate policies for a long time. And I think the equity markets is still living in that environment, and it's still living in an environment that people used to think where zero interest rates allow multiples to be at extreme levels. In my opinion, we just don't. I mean, just give an example. Over the weekend, I looked at the Dow Jones and other indices relative in gold prices, and today the Dow Jones or the S&P and other are actually at the same levels they were at the very peak of the 1929. And the fact that we are there and people don't perceive that as risk is just tells me that investors are completely clueless about the actual risk of things in terms of being overvalued, the concentration in the market, the lack of leadership from the broadly speaking of the breadth of the market itself. And in my opinion, that's very problematic over time as well. And especially at a time when rates are particularly higher than they have been. And we're not living in that world still. And so valuations have still, you have to adjust for those changes. And so I think that would be negative for equity markets. But yeah, I've been having this view for a while, and I still think that you always think about risk reward, and I just don't understand the actual reward of being in that part of the market, given the fact that it's just so overvalued. And I think Senzel has a great phrase on this. Great money is made where capital is constrained for most businesses. That's not the case with technology. Capital is not constrained. Capital is just flowing there like there's no tomorrow. Everyone is a technology expert. That's not the definition of where great money is made. Great money is made where there are issues and liquidity problems, and that's where you get your bargains and so forth, and great negotiation tactics to build a position on something that is likely to change. I can't think of anything like that outside of the natural resource space that has been so neglected for so many years, and emerging markets too. I mean, look at the charts of emerging markets versus the US equity market. I mean, there's no lack of capital here. So it's hard to see how this will continue to be a great opportunity 10 years from now, when there's all these other places that deserve capital at some point. And we know that these things shift from, equity markets leading to then emerging markets leading to then commodities leading. We've seen this throughout history. I think that's highly likely.
Okay, so generally speaking, are you advocating for a rotation to bonds from equities? I just want to make sure I get your thesis right, or no?
I actually think financial assets are extremely expensive, particularly in the US, and long duration. I am advocating for real assets. I'm advocating for commodities. I'm advocating for tangible assets. I think those are going to be a larger percentage of portfolios in the near future. And I think businesses that produce those commodities, those assets overall, will do very well. Also, I think there are countries that tend to benefit from those trends. And I think that most emerging markets with large exposure to natural resources can do very well. That's what I'm advocating for. I don't think that the 10-year yield, the 30-year yield, treasuries look attractive. I don't think, no, the idea of T-bills and chill is the fact that, back when people were talking about T-bills and chill 7 months ago, we had 7 interest rate cuts already priced into the curve. Now we have two. Okay. Gold was trading at 18, 1900. Now it's trading at, whatever, 23, 2400, depending on the day. So there has been a shift. Now, I'm not bearish on gold. I think gold is going to do very well in the next 5 to 10 years. Now, the fact that you can get near 5% yield, 4% yield on the short end of the curve, and nobody thinks that, everyone has the view I had 6 months ago, and inflation is going to reaccelerate, therefore we're not going to see cuts. Yeah, that was the right change of view, a month or 6 months ago. Now that has been already reflected in markets. I'm trying to be ahead of this, and so I think that the risk is not necessarily to be cute about inflation, but honestly, I really think that the deceleration of growth and the cracks in the labor markets are going to take a much bigger part of the narrative moving forward. And
Let's talk.
Yeah, go ahead.
Yes, a good point. Yeah, cracks in the labor market. By the way, let me just read you a paragraph from a Yahoo article about a Citigroup analyst report, which broadly supports your thesis. Okay, so they're calling for, on a note that was released Friday, they're calling for the benchmark rate to drop 200 basis points, which means possibly 8 straight cuts starting September, is their view. They're saying that, like we talked about already, the ISM manufacturing index has been trending down. The unemployment rate is now 4.1%. It's raising the risk of a sharper weakening economy and a faster pace of rate cuts. They're calling for the first rate cut to start in September and subsequent rate cuts up to 8 consecutively. Does that broadly make sense to you?
I think that it makes a lot of sense, actually. I think that I don't think this is a opportunity that has been played out yet. Meaning, if I think about the greatest macro strategists and traders in the world and investors, Druckenmiller comes to my mind, and I would think that Druckenmiller would be all over this idea already. And it wouldn't surprise me, especially technically looking at the 2-year yield, that we would retest the levels that we actually broke out from, which would be that 2% kind of range, or I should say approximately 2% area. And, would make a ton of sense if that happens. And so the idea of T-bills and chill, although referring to 2-year yields all the time, their yields are not very different in that part of the curve. And so, essentially the short part of the treasury market, perhaps for those that play that market, looks a lot more attractive than it was 6 months ago. So, it is something to be aware of. So I do think the labor markets are showing cracks everywhere. I mean, the full-time employment decline, contraction that we're seeing, and that often happens during recessions. The idea that we're seeing government jobs, especially job openings in government related jobs, as a percentage of overall job openings at one of the largest levels we've seen in history. And that trend tends to be also very recessionary. We're seeing bankruptcy filings already starting to show issues. The divergence of small cap companies, Russell 2000 and others, relative to NASDAQ and others, it's important for your viewers to know that 2/3 of the labor markets come from small companies. And so if they are not performing very well, how do you expect labor markets to be so strong? So those are all important changes that are happening that I think will show further deterioration in those numbers moving forward.
You brought up gold, so let's talk about gold for a minute here. You have a slide here on one of your slide decks that shows China's gold rush. It's a chart showing the price of gold and then also U.S. Treasury holdings from China going down. Certainly a stark inverse correlation. Are you suggesting, Tavi, in this chart that much of gold's rise this year was due to China's either dumping of treasuries or buying gold or both?
I think that has been a big component of this movement in gold. Has been the fact, I think the gold bugs have always believed that central banks are buyers of gold and would ultimately come back. That view has been confirmed recently. Central banks are buying gold. China is not alone. There's other economies that have been buying. And by the way, we're talking disclosing purchases, which who knows how much it's happening undisclosedly as well. it's a very important point because the math of the disclosed amount of gold does not really justifies the large movement in price that we've seen recently. In other words, undisclosedly, there has been a lot more buying that we know of. So, who is actually accumulating? Who knows? But we can all have views about that. I think China is facing its own Japanification moment in terms of what happened after the bubble, the real estate bubble of the late 90s and the late 80s and so forth in Japan. And when Japan actually went through, rather than stagflation, they went through something called stagnation. And I think China is facing something very similar, and it's in much more desperate need to improve the quality of its reserves in order to preserve as well the stability of its monetary system. It's a huge aspect of the Chinese economy, and so I think that the ownership of gold and that transition towards gold, it's happening across many places, but really China has been sort of a leader of that movement more recently in a scale way. And I would also point out there was a research asked by a bunch of central banks and survey of what the main reasons for owning gold really is. And one of the main answers for that was also the neutrality aspect of gold. And neutrality meaning the deglobalization trends we're seeing and the need for countries to own a security that doesn't depend on another economy is such an important aspect. And gold, in terms of the history and also in terms of being a neutral asset, is the only alternative that really offers that. You can say Bitcoin, but Bitcoin doesn't have anywhere close to the history of gold. And so central banks take note of that and obviously been accumulating the metal over time. And so this is an important trend to be aware of that I think it's only getting started.
Do you think that gold is waiting for another catalyst? It's been hovering around $2,300 to $2,400 for a couple of months now, range bound, while the rest of the markets have either moved up or down. Gold is just flat. What is it waiting for, you think?
Well, I think there's a lot of things going on that could drive gold. If you think about the dollar itself, I mean, gold and the dollar can rise together, but I do think that the dollar is looks to me like it's in an inflection point. And the main reason for that is I pay attention to assets or asset classes that are not moving when they have sort of a tailwind, behind them. In this case, with the dollar, I can recall a time in history when the interest rate differential of treasuries versus other sovereign debt across the globe, especially developed economies, has been this acute in terms of the difference. And so I think it shocks me that the dollar is not stronger. Why is the dollar not stronger? Why are we not receiving even more inflows on the dollar? And the dollar is, taking off in an environment where it should be, given this changes of interest rates. And I think it has to do with expectations of what the Fed is likely to do. But I also think that it speaks volumes about the demand for the dollar more recently. And I would suspect that we're getting close to a bottom in a lot of other currencies relative to the dollar. And that could become actually a very important catalyst for gold prices to go a lot higher. Gold prices have broke out from a triple top recently, as you know very well, and has been sort of consolidating recently in this levels, and that's normal. A lot of asset classes, especially like this, the size of the gold market, will actually do that. It's very important for us to understand where would that demand for gold come from. There's so many places it could be coming from. It could be coming from central banks. We're still to see the institutions of the world, the family offices, the pensions, and 60/40 portfolios transitioning to the gold space. And I think that's ultimately going to happen, especially in a world where the volatility for the bond market, especially the treasury market, continues to stay higher for longer here. And if that's the case, the needs for an alternative that is safer than treasuries, that is less volatile than treasuries, is actually becoming higher and higher demand. And I think gold will be that alternative that will eventually become a defensive assets for those allocators. And so we're yet to see that money transition back to gold. And I think we're in the process of seeing not only some education process of that, but also, folks are starting to, understand better what this precious metals market has the potential to do in a bull cycle for gold, which I think we're in one right now.
Speaking of the dollar, the dollar also depends on interest rate differentials. As you know, the Fed is keeping rates higher for longer, while other central banks, including the Bank of Canada and the ECB, have already started cutting rates. If this continues, one could speculate the dollar could get even stronger, which may or may not weigh down on gold. What's your view on that? Why are other central banks cutting first, even though, take the Bank of Canada, for example. In Canada, the inflation rate's at 2.9%. It's not nowhere near its 2% target. Why are they cutting before that?
First of all, I think it's a lesson that central banks, people used to say the Fed will never be able to raise rates, right? And then the Fed did raise rates. And now the same people that said that are now saying the Fed will never be able to cut interest rates because inflation is too high. Now, the lesson from other periods that we are currently living in, which by the way is unprecedented, but there are some similarities, is that financial repression will take place at some point. And we're seeing that in other central banks. They're not the reserve currency. They don't have the same level of stability of their currency. And I'm not here to say that the dollar is as stable as gold or other things, but it certainly is more stable than other places. But that stability is really on the back of growth and on the back of particularly growth that is driven by the fiscal dominance relative to other places. Now, as I said before, I don't think that fiscal dominance is sustainable because of the interest payments we have relative to GDP. The US today has the highest net interest payment relative to GDP than any other developed economy in the world today, by far. And so, think about that. Like, can we continue to run 4% of GDP just to pay down debt moving forward? And by the way, that's only going to increase because that's really predicated on interest rates that have been a lot lower. As we see interest rates, or I should say, treasuries being rolled over, that can actually increase drastically from here. So I think ultimately the Fed is going to actually have to take the path of those economies. And most of the people that don't believe that the Fed can actually cut interest rates with inflation being hotter than historical standards, I think they're going to be caught up in a very wrong place here. In other words, I think that is a supercharged environment for real assets. The financial repression, along with inflation staying higher for longer, is probably one of the most important macro thematic ideas for the coming decade. And that's the main reason why gold is likely to go to stupid levels, most likely, silver, copper, and you name it. And therefore, I'm very bullish in that part of the market.
That was actually my next question. Which of those real assets you mentioned you think have the best potential?
Well, I personally like a lot the metals and mining space. And the main reason for that is because of what's happening in that industry overall and the understanding of how long it takes to build a mine. There are studies that S&P Global did recently that show that would take about 16.7 years, I believe, or 15.7 years to build a mine today. And that's really looking at 127 cases over the last 3 to 4 decades. But if we think about here, David, in the last 3 to 4 decades, it's been one of the most globalized environments we've seen. An incredibly low cost of capital, very low energy cost. Is that the world we think we're going to be in 10 years from now? Probably not. We're much more deglobalized. Energy costs is likely structurally higher. We're probably seeing interest rates being structurally higher too. Inflation is playing a role. So the difficulty to build a mine is going to be even worse. And so that is ultimately what drives metal prices a lot higher. And perversely, which a lot of people would say that I'm not investing in mining, ultimately metal prices being higher fundamentally justify capital going back to mining, which we've seen this historically. In the 70s, we also saw a very similar kind of setup where there was a lack of discoveries, just like today, a lack of capital, completely neglected. The industry was dead. And then guess what? That was the period that it came back because gold prices and other metals actually went through a long period of a bull market. And so I think we're actually in a very interesting environment of that. In fact, when you look at mines and projects, what I find fascinating is especially because I come from, yes, I've been specializing myself over the years into the mining industry quite a lot. However, I am still a generalist. I still think of the world as a generalist. And to me, it's sort of it explains why we're seeing generalists so scared of the mining industry is the fact of how they are pitching themselves and how the overly conservative way of presenting their numbers is the main reason for this. So I'll give you an example. As we look at mining projects to purchase and acquire and so forth, one thing that I'm seeing that is it's not shocking, but really I think almost like an arbitrage opportunity is how they tend to estimate massive cost inflation. But then you look at the metal prices and what they expect. I mean, look at any of these mining companies and you look at what they expect for metal prices, you see deflation. David, I don't know anybody who thinks we're going to see massive inflation and deflation in metal prices. Like that just seems ludicrous, really, from a macro standpoint. And so if assets are being sold under those assumptions, sign me up. I think that's a great opportunity. So I think, if you looked at, for instance, where capital has been flowing a lot more, an industry such as AI, or I should say a sector of the economy such as technology, is quite the opposite of that. You look at estimates for their products, and they are all, their estimates are massively overly optimistic, in fact. And their cost structure is supposedly to be shrinking and not growing to the same degree that we're seeing. Now, you got to ask yourself, I mean, is that more likely than what, perhaps how the mining space is being priced in? No kidding. No general investor wants to come in and invest. They look at forward earnings for most of those mining companies. Those numbers make zero sense. Yeah. And they're highly unlikely to be that way in the future, especially in the future that I believe we're going to be in 5 to 10 years. So, I think that this is the type of opportunity I like to be not only invested, deploying capital, but really, putting most of my energy as well.
Okay, I understand the shortage aspect of these commodities if we're taking longer to build a mine, but let's just talk about the mining business now. It sounds like you kind of made a bearish thesis for mining stocks, even though that's not what you're trying to do. But just on the surface, as a generalist, that's what it sounds like. Let's talk about this. Why is it taking nearly 16 years to build a mine now? The time to build a mine has increased. Why is that?
Well, I think it's the ultimate factor that causes the mining industry to rise. It has to be on the back of a very strong metal prices. I mean, we've seen this historically. Every time it has to be on the back of a very favorable macro scenario, and that is what I think we're going to be in. I think that the fact that we have been, and the question that you asked about why we've seen such a difficult environment to build a mine. First of all, it's very hard to build a mine. About 70% of that time that you refer to is actually caused by the discovery phase. The difficulty of finding a discovery is basically what causes the timing constraint to go from discovery to producing asset. The building of the mine is actually not as time consuming as that discovery phase. In fact, it doesn't really matter if you're underground or open pit as much in terms of the construction phase of it. While that has been like a very conventional thought that underground mines take longer than open pit mines. And that's really not shown in the data. But it really comes from the back of what's changed over the years as well in terms of the Green Revolution, the political environment that it's been very difficult to allow mines to be built. But that's the need for it will change that, right? I mean, as we see prices going up, and this idea that we want to be living in an AI world, everything is driven by AI. We need to build a lot of things if that's going to be the case. Now, before this conversation, we're talking about the housing market. Well, how do we fix the housing market? Well, we got to build. And, somebody was saying, imagine how deflationary it will be when we have robots and all sorts of things. I'm like, do you know how much it costs to build a robot? Have it ever come to your mind how we're going to build them? So all these questions are really unanswered by most of the technologists. And
you know what I think will be happening in the future? We're talking about we're going to have huge buildings in the middle of downtown just to house the robots, because at the end of their, you have to store them somewhere, right? They're going to be huge storage centers that's going to take up real estate space. Anyway, that's just a thought.
Well, the electricity demand that will be driven, and I've seen folks talk about, at some point, electricity will be, ultra cheap in the future. Yes, but we're not in that world yet. I mean, in that world, we need to build things first. And so I think that that's really what creates and by the way, if you are of the
Right.
bearish view on the mining industry, welcome to the crowd. Everybody is, okay? You're not alone. The whole world thinks the same thing. Therefore, why we see the lack of capital and the opportunity, in my opinion. So it's
Well,
not a contrarian view.
tell
It's a
tell us about this. Okay, so in the last 1 year, so I'm just looking at a 12-month chart. The gold price is up roughly about 25%. Okay, now the GDX, which I know is not indicative of the entire mining index, I'm just taking the GDX as an example, mid caps to large caps index. It's up about 18%. Okay, so it's not a huge difference, but it hasn't been outperforming the gold sector, the gold mining, the gold
yeah.
metal, right? So you're looking at this in one of two ways. I've been told by people in the space that this is a great opportunity. It's a great value for all these miners. I'm looking at this as a generalist, perhaps looking at this and saying, well, this just a value trap, right? How do you reconcile the two differences here?
Well, I think first of all, that view that we're going to see higher gold prices and lower mining stocks performance is the most historically unsupported opinion I've ever seen in my life. And you can't support that throughout history. I mean, in the 40s, in the 70s, in the 2000s, you name it. Every bull market in gold also coincided with a major bull market in the mining industry. So let's start there. History does not support that view. And I think that's the main part of it, by the way. The fact that we have overly conservative people and the fact that we have, the overly pessimistic folks about the mining space, to me, it's just a sign that we're at a bottom or near a bottom, right? I mean, we've been there for a while now, but the difference is that the metal prices have been a lot more constructive than they were back 3 years ago. We've seen people come along in terms of, okay, we might need copper, in this world. We might need a lot more zinc. Gold is actually, does have demand from central banks. Oh wow, that wasn't the case, maybe as much as it is today 3 years ago, or since the Russian invasion situation and so forth. And so in Ukraine. And so all these things have shifted. And so when you think about the check boxes of making a structural bull market for gold, they're all checking, right? It's just the pessimism is there. And ultimately that changes that view. I think about this, about how many people have to change their opinion from bearish to bullish would be significant and would drive prices ultimately. I had a price chart of GDX, or the miners versus gold, and maybe you can show your tweeted not too long ago, that shows basically the mining stocks basically been in a downward trend while gold has been in an upward trend recently, and we are actually hitting a resistance there for a while now. And if you ask me, I think that's we're set for we're setting the stage for a major breakout in the gold mining industry that a lot of people don't believe. And imagine all those folks going from overly bearish to overly bullish, and what would that do to prices overall? So if you don't believe me, wait for the breakout. But I will, I've been certainly busy trying to acquire mines and projects and companies prior to all those movements, because I think
Yeah.
that's where the big money is made.
Do you prefer the juniors right now or the seniors? Presumably, the seniors are making good cash flow with gold and even silver at current prices. But like you just said, the juniors have a lot of potential as well.
I think there are different takes in that question, because I think every person will have a different view here. But been in this market for a while now, I think that exploration is absolutely needed in this environment, and a lot of people have, which makes sense, right? I mean, the further you go in terms of how early the stage of the company is, the not only less capital because more risk, but also less group of knowledgeable people and more inefficiency is shown. And that's really predicated on the fact that the more to the early stage you go, the more geology you need to know. And there is a lack of geologists in the world. There is a lack of people that understand that industry, and therefore that is reflected on the inefficiency. So I definitely see that the exploration space is highly, highly inefficient. But recently there has been a lot of opportunities of spin-offs of major companies in terms of their projects that they've been looking to sell, in which I think look highly attractive, especially the ones that have this perceived low, very low mine life expected, in which most times tends to be highly conservative numbers, especially in a world that I think we're going to be in with gold prices moving to 25, 3,000, and even a lot higher than that. And if we think about just how reserves work, if you see the prices moving higher, the cutoff for those reserves, resources, and so forth are reduced. Therefore, what it means is that more ore will become economical again. And so as we see that happening, the reserves are going to be increasing as well, which will have an impact in the fundamentals of most mining companies. And so I'm paying very close attention to those deals that are appearing in different parts of the world for us to be acquiring. And I think there will be even more opportunities like this. If you ask me, I hope the mining industry doesn't really break out here soon, so it allows me time to buy more. And even a dip in the gold market would be great, but I have zero control of that, and it's certainly not my view. So I
Are you
would
telling me you're not a central banker? You have no control? I'm kidding.
No, I'm telling, yeah, that's a good joke, but I'm telling you, I would welcome a decline. And
Yeah,
I
I
don't know if
understand.
I said this to you, David, before, but a huge part of an investor is to have conviction. I've said this before to other folks, but I do believe that somebody can borrow your thesis all day long. They can say, well, I saw this person speaking at a conference or an interview, or I saw this tweet about this idea, and it's such a great idea. However, every thesis will be challenged at some point. I don't care what thesis that is, it will be challenged, because that's what markets will humble you. And ultimately, what will show that shake up situation becomes an opportunity is your conviction. So you can borrow my thesis all day long, but you will never be able to borrow my conviction. And that is ultimately what creates this major opportunities where great money is made, as Senzel said. It's in those situations.
Final question before I let you go. Do you have a floor for gold? I know we talk about upsides, but is there a bottom for you such that if that floor is breached to the downside, you would think this is now a new bear market for gold?
I am not a technical guy to answer that question, and I think technical guys will come up with crazy targets on that front just to justify that. Markets
It
are
just
really.
conceptually, is the floor of gold always the all-in sustaining cost of the large miners?
Oh, you can say that, but we've seen this overshoot as well to the downside too. And it's uh, look, I think that the world that the miners would really lose money would be the world that they're priced in as, which is cost goes massively higher, and we see deflation in metal prices. But that's already in the price. Just keep that in mind. That's already in the price. What if we see the opposite? What if we see metal prices rise with cost rising? Okay, that's a change. That's a positive change from what's the prices. What if we see somehow efficiency? Now, I don't know, AI somehow helps efficiency. I'm not here to claim that, but there is definitely room for better operations out there. And what if we see a world like that with higher metal prices? Is that really reflected in those historically low multiples today? No. And so, I think the room for change, for positive change, is tremendous. And that to me makes me excited.
Perfect. I like to bring the audience's attention to your work now. Where can we follow you, learn more from you and Crescat Capital?
There's nothing to learn from me, to be honest, but I put out a lot
I
of
learned
work.
plenty in the last 40 minutes.
I
That's not
wouldn't
true.
I wouldn't say that, but you can go to my Twitter account at Tavi Costa, and I put out a lot of analysis, mostly daily, on things that I believe. Do not try to day trade anything I put out there. That's not the idea. I'm just sharing a thought about how I think about conviction of allocating capital long term. And the same goes for Crescat, Crescat.net. We put out letters, a lot of research, and we also manage money for clients. And so we invest not only in we have a macro fund, a long-short fund, but also a precious metals dedicated fund and a commodities fund. So it's been busy, but there has been a lot of great opportunities out there. And I would suspect that I will continue to be busy for a long time.
Well, congrats on your success. That's why you're busy. So we look forward to following up with you again soon, later in the summer, hopefully. Thank you again for coming on the show.
Thanks for having me. Appreciate it.
Thank you for watching. Don't forget to like and subscribe and follow Tavi Costa. The links down below.